Good afternoon, and welcome to Study Group 14's presentation on economic forecasting. Few areas within economics have proved as controversial as forecasting. The area has sparked great hopes throughout the 20th and 21st centuries of predicting future economic trends, but these forecasts have also often come up short and unreliable. Our presentation will focus on different economic indicators which have shown promise, and we will look into to what extent these can offer some hope for the future.
Hi Nick, thank you for having me.
Great to see you. Tell us about your research into the field of inventory as an economic determinant for future growth.
Well, thank you Nick. You see, inventory is a very important measure of economic forecast. It has very basic and logical explanations to it, right? Inventory is what most American companies use to generate their sales, right? They sell their inventory. So inventory levels are very significant in terms of future growth and future growth forecast. It's a very logical explanation, right? Having high inventory with respect to sales can mean two things, Nick. It can mean that you're expecting higher demand in the future, so you're bulking up your inventory in order to take advantage of that future demand. Or that you thought your sales were going to be higher and you're stuck with low inventory turnover, and this means bad for your business.
That's very interesting. And when do you suggest we should use this indicator?
Well, I would say it's most effective in periods of post-crisis. For example, after the recession, inventory levels were the main economic indicator that analysts were looking at to try to forecast the recovery. To put it in some way, Alan Blinder was one of the Fed's former governors, right? And he said, the business cycle is the inventory cycle. What you have as inventory will tell you how much you're expected to sell in the future.
Oh, that's interesting. So you're suggesting it's a pro-cyclical indicator?
Absolutely, yes. You shouldn't look at inventory straight away. If you try to compare it to a measure of GDP, you know that GDP is the measure of all produced goods, right? If you take out of the GDP a measure that tells you how many of these goods were sold, you're left with what's called net inventory, okay? So actually, when you try to explain growth of GDP in terms of net inventory, you see that it is very correlated, and actually the net inventory is an extremely volatile measure for it. So it makes sense to look at it in terms of post-crisis scenarios.
Thanks for that, Alex. Hi, Meishan. I know you wanted to talk about the housing market and how that can kind of play a role in future economic forecasts.
Hi Nick, thanks for inviting me to talk about the housing market. The housing market is generally the first economic sector to rise or fall when we do the economic forecasting. And the housing permits will be the early indicator of activity in the housing market. New residential construction will generally lead to another type of the economic production. But just like with the inventory levels, the housing markets, people are willing to buy, the housing price are likely to decline, which devalue the entire real estate market, not just the new homes.
Hi, and welcome back. Nijat, why don't you talk about what startups have and what kind of value they can give as an economic indicator?
Yes, sure. Thank you, Nick. So, in my opinion, if we need to analyze and predict the economic growth or the crisis, we need to analyze the startups of the whole economy. There are two main reasons for that. The first reason is the technological progress. The main outcome of technological innovation is the reduction and automation of manpower to perform a certain task. The most of the startups today, like Tesla, they are profitable today because of the huge humanitarian innovation rates that they receive. This technological progress can increase the productivity in the economy and boost the economy. If we look at the recent example of Octane and NeoHydro in the US, they found a new innovative way of extracting oil, which influenced the whole economy. The second major thing is the job creation. As new businesses enter the market, a huge number of high-paid jobs become available. This reduces the unemployment rate in the country and boosts the economy. Tim Kaine, the American economist, in one of his research, he concluded that the majority of job creation in the US comes from the startups.
Hi Mike, with all these fantastic tools that have been presented to us, how do we actually do in terms of economic forecasts?
Well, it turns out we do surprisingly badly. So, for instance, the IMF, which is responsible for forecasting GDP on both a global and countrywide level, actually has a 1.5% error at just a 3-month lag in predicting global GDP. And in 2009, when of a sample of 77 countries, 49 went into recession, they failed to predict a single one of these even by April of the previous year. So in fact, when it comes to predicting recessions, if I was to take a random number generator, I would do a better job than the IMF who uses high-level economic analysis.
That's quite shocking. Is that a trend which only works for the IMF?
No, actually, the Wall Street analysts themselves are pretty bad at predicting these trends as well. So for instance, if we're looking at the yield on US T-bills, there's actually a 60 basis point average difference between the actual yield and their predicted yield at a 6-month lag. Furthermore, if we were to look at the S&P 500 returns, you'd find that on average there's a 14.7% difference between Wall Street's estimate and the actual S&P return for that year. So they have never actually predicted a negative return in any of the last 23 years. And if I was, again, to just take the average return on the S&P 500, I would do a better job than the average Wall Street analyst.
Well, it's very interesting. Thanks, Mike. Just goes to show there's two sides to every story. Hi, Susan. So, kind of building off of what Mike was talking about before, why do we get our forecasts so wrong?
Okay, so let's talk about most common mistakes. So firstly, the samples can be biased or mistakenly measured, or they might not be representative for the whole population. Secondly, researchers often do mistakes in their models, so they use too many or not enough variables. Moreover, the optimal forecasting model, the structure of this model might change, and if those changes are not accounted for, the forecast will be clearly wrong. And finally, some economists believe that because of our current state of knowledge, we are just not able to predict future accurately.
Ah, that's interesting. Thanks for that. Now, I know your views coincide quite closely with those of Nassim Nicholas Taleb. Maybe could you expand more on what his writings have been?
Yeah, so in his famous book, The Black Swan, The Impact of Highly Improbable, Nassim describes so-called black swans, so events which can have devastating effects and are perceived as obvious in hindsight, but when they occurred, they were surely not perceived as such. And he tries to understand why people still believe they can forecast future accurately. And he comes to the conclusion that because we are hardwired to find order in patterns and in events which might not be really correlated, so we turn scattered points into kind of coherent narrative. And he is quite concerned because it might be dangerous if we believe too much in our forecasting ability.
Ah, thanks for that. That was really interesting. Thanks for your attention, guys, and I hope you enjoyed that as much as I did. Join us again tomorrow for another economic discussion.